Welcome to Risk 66 Accelerated Training video on Captive, a Suggested Decision Process. I'm Tim Coomer. Let's get started. A captive is a limited-purpose licensed insurance company. The main business purpose of a captive is to insure the risk of the captive owners and/or associated third parties. Very similar to a traditional commercial insurance company, it sets insurance premium rates for the risks it chooses to underwrite, writes policies for the risks it insures, collects premiums, and pays out claims made against those policies. Captives are designed to enhance the parent's risk management program and/or enhance the corporate bottom line. There are some key differences between a captive and a traditional insurance company. More flexible regulations govern the captives. A captive cannot offer direct insurance to the general public without a fronting carrier. A fronting carrier is a licensed commercial insurance company that issues policies to the insured. The fronting carrier underwrites the captive's account and is the one that actually issues the policy. The risk is then transferred from the fronting carrier to the captive through a reinsurance or fronting agreement. There are several types of captives. Single-parent captives, captives with a single owner for whom they provide insurance coverage. These are often described as pure captives. Risk retention groups. Corporations are limited liability associations formed under the Federal Liability Risk Retention Act of 1986, formed for the purpose of assuming the liability exposure of their members. Rent-a-captives insures the risk of its renters and returns underwriting profit and investment income participation to the insureds. Group or association captives, formed by a pre-existing association to provide insurance coverage for members. Agency captives, a reinsurance company owned by an agent or group of agents, formed by brokers or intermediaries for their clients. Special purpose captives typically are specialized captive insurers designed to act as a special reinsurance vehicle for life or property and casualty insurers. There are several reasons to form a captive: reduced reliance on commercial insurance, reduced cost of risk, stabilization of pricing, ability to provide coverage for certain risks that are unavailable in the conventional market, access to reinsurance markets, improved cash flow benefits, reduction of government regulations and interference, ability to customize insurance programs, formal allocation of deductibles for self-insurance retention within a corporation, underwriting advantages, opportunities for improved claims handling and control, creation of a profit center, tax advantages, enterprise risk management and strategic risk financing, and the ability to direct investment options. There are some disadvantages to starting a captive. Increased administration burden. A high degree of delegation and partnership is required when engaging a captive management company. A significant management time commitment may be involved. The parent company must acquire relevant expertise for all the insurance-related disciplines. A captive's existence may complicate merger or acquisition activity. There are some financial disadvantages of a captive: volatility of reinsurance markets, capital commitment, especially during the initial stages of captive formation, runoff. Changes in the parent company's business plan could result in the captive being placed into runoff. Expenses of a runoff produce no current economic benefit. A captive that is in runoff is still responsible for the liabilities of the policies under the treaty until the expiration date of each policy if the policies became effective prior to the treaty cancellation date. Here are some general rules of thumb to consider before starting a captive. Premium should be sufficient to achieve savings and cover expenses. Generally, a premium to capital surplus ratio of 3:1 to 5:1. Loss ratios for the coverages should be low enough to generate surplus and be able to sustain any potential adverse losses. Initial investment of capital is needed. A minimum is about $100,000, but it depends on the domicile selected and the business written. Here are some questions to consider internally before forming a captive. What needs will the captive address? Is the parent organization willing to make the necessary commitments? Are the goals of the captive and the organization focused? Does the concept of a captive mesh with the overall corporate strategy? Is there a strong leader? And who will own the captive? Putting together a captive typically involves a lot of external professional advice. These include from the actuary, tax and audit advisors, legal advisors, investment advisors, brokers, regulators, and key stakeholders of the organization. All domiciles will require a feasibility study as part of the business plan application. A feasibility analysis involves the following: actuarial analysis of insurance programs and determination of appropriate premium, reserve, and surplus levels. Attorney or tax advisor review of the tax consequences of a captive, in particular, tax deductibility of premiums paid to the captive, captive tax structure, and overall program structure. Domicile selection is based on a variety of factors: experience of the domicile regulators, receptiveness and experience of the business under consideration, financial considerations, travel considerations, and tax outcome. The feasibility study also includes preparation of pro forma financial statements in consideration of the actuary's work, the captive's tax status, and the domicile of choice. Assessing service providers and insurance carriers for partnership value, building a 5-year strategic plan for captive utilization, and exploration of overall program structure and dynamics in order to best develop an operational scheme which meets strategic goals. Here are some common traits we see when working with successful captives: a commitment to the long-term solution, strong governance, strict underwriting criteria, well-capitalized and funded program, the commitment to loss control and claims handling, surrounding a captive with strong, experienced business partners, and proper due diligence of all business partners, which is one of the most important things. In conclusion, forming a captive is an important decision, and the Captive Feasibility Study provides the framework within which you can make an informed decision. For expanded information, see the resources listed along with this video or contact Sigma Actuarial Consulting Group at support@sigmaactuary.com. Thank you for taking time to watch this accelerated training video on Captive, a suggested decision process from Risk 66.